Good morning and welcome to this final interest-bearing webinar for 2024 with me, Kelly. Joining me on the panel today, from the right-hand side, my right-hand side, I have Bastian, our Chief Investment Officer, Hannah, Quantitative Analyst within our Cash and Income team, I have Reza, Head of Bonds, and Michelle, Credit Analyst. So Basti, if you can set the scene for us, what have been the dominant macroeconomic drivers in the last quarter and how has that impacted capital markets?
Thanks, Kelly, and thanks also from my side to everybody. Kelly, I'll start with fixed income returns. So we had a very strong first part of the second half of the year, so to say, very strong third quarter. We had credit spreads tighter locally and globally, which obviously supported riskier fixed income assets. And then we also had, initially at least, compression at the back end of the curve. That's also globally and locally, which supported riskier fixed income exposures. And what we did see, though, at the back end of the last couple of weeks is that the US 10-year rate has actually increased a bit, so that's the only detractor from a more macroeconomic point of view, and that explains the majority of these moves. We have observed that the second half of the year was a little bit of a tale of two. So we started off with quite weak economic data, especially non-farm payroll data or the labor market report in general, surprising on the downside. That led to a little bit of recessionary fears. We had the triggering of the SARM rule, which led to a little bit of uncertainty. Plus, on top of all of that, we had the Bank of Japan doing a surprise interest rate hike. So that was like the bad news at the beginning of the third quarter. What we then saw after that is pivoting in markets, so to say, where all of a sudden we had strong economic data. We had positive surprises on the Fed side. Yes, we were partly priced for a 50 basis point cut, but it was in between 25 and 50 bips, and 50 bips being delivered was positive for markets. And then last but not least, particularly good for emerging market bonds, and with that for South African bonds, we saw a stimulus out of China, which was obviously also quite supportive. So a bit of a tale of two, and but I guess the positive thing especially was the back end of that period, which we're covering now, where we saw the turn in positive data in the United States.
Yeah, so perhaps you can give us a little bit more information on that, because that has been quite topical in the market. US economy, recession, not a recession, like you've mentioned now. Beginning of H2, we saw that slow down, and now we're seeing that new uptick. How do we track this at Prescient?
Yeah, that's a good point. Now, that's really the dominant theme. So we use a Prescient economic indicator to explain the US economy in real time. That works pretty accurately, pretty well. It has formed our house view over the last 4 years, basically since the COVID recovery, that there would be no recession around the corner. And that came out actually the right way. So we never suspected this deep recession, which was talked about at times, to be around the corner, mostly by the mere fact that the data never really supported that. Okay, so what we're showing on this chart is a basic non-technical overview of the Prescient economic indicator. You can see that we're breaking the US economy down into its main contributors, being generally gross private domestic investments, consumer sentiment, net exports or imports, business confidence, financial conditions, gross domestic income, etc., etc., etc. And I'll just open one of those categories a little bit more into detail. And I'm using the labor market conditions here. What you can see is that there's a lot of sub-indicators here, and it helps us really to track and understand each and every labor market report into the last detail. So that's how we are able to really form a view on the US economy in real time. If we bring that closer into like a line chart, I guess it makes it easier to understand. And then we zoom in a little bit. Well, first of all, what you can see is that the dark blue line, that's real GDP as it really printed, and then we've got the turquoise line, which is the Prescient economic indicator. You can see that those two lines are tracking quite closely, which means that our predictive models actually work quite well. The more interesting bit occurs when I really zoom in and see what that is telling us right now. So on the right-hand side of the chart, if you just focus on that, you can see that real GDP, that's actually released data prints of the gross domestic product in the States. You can see that ends in June 2024. It ends in June this year, because that's the last data release we have at 3%. But the interesting bit happens after that. So the turquoise line obviously carries on, because every single day we get an update on our estimate. And what you can see is that we can track the slowdown here as we go along. This is where we had our last webinar. We maintained the stance that there's no deep recession on the cards. That's based on the information that turquoise line never dropped below the zero line. But we said that the theme for the second half of the year was the key observation of what happens to this turquoise line, whether it keeps on dropping, whether it falls off a cliff, or whether it does something else. And turns out that it does something else. It actually starts to recover quite dramatically over the last couple of weeks. And that's indicating that the US economy has really started to re-accelerate. And that's obviously a good story for quite a few of the risky assets, like, for example, our South African government bond market.
Thanks, Bastian. As you mentioned, it's really positive news in terms of global growth reacceleration. How does this impact our house view?
Okay, good point, Kelly. With more global growth, the fear is obviously now for fixed income markets that we will see a Fed which is about to cut interest rates slower. We think a little bit of that is already in the price. There was a repricing already happening for like how far or how deep the Fed is going to cut. But we do think that it's very important to consider inflation in this equation. And if you look into the inflation conundrum, we can see that there's still very little demand-side driven inflation. We still have inflation mostly dominated by the shelter component, which we expect to continue its slowdown. So with that, very little fear of inflation being one of the drivers to keep interest rates higher for longer. So that's really not our scenario. We do acknowledge that the Fed can, while they can still cut, they're probably not as fearful and not as pressured to cut as we've seen it earlier in this quarter where the economy was looking way weaker. So now they probably still want to cut, but they can afford to move a little bit slower. Okay, so what we can see on this chart is the pricing of the Fed fund futures. So basically where market participants are expecting the Fed to move interest rates to. So if we start at the top with that red line, that's basically the current level of the Fed effective fund rate. You can see it sits at 4.89. That's the window which the Fed is targeting between 4.75 and 4.5. So they're basically in the middle of that, which is usually the case. And then what you can see in the blue dots is that the market is telling us that interest rates are going to come down. That's not too much of a surprise. So quite a few cuts are already in the price, as we've said earlier. But what is more interesting is if we contrast that to what was priced a month ago. So if you compare it to that turquoise line here, this is where we've been a month ago. So basically before the data started to re-accelerate. And what you can see is that there's been kind of 2.5 cuts more priced, which now have been taken out of the system. And that kind of has driven at least the back end of the US curve, where we've seen a little bit of a sell-off as of recent. But that's really the only part of fixed income assets which have underperformed. The rest has really enjoyed strong returns. Just want to add one chart to that discussion. And if we really look at the sheer number of interest rate cuts which have been priced, and we focus for the end of 2025, I think the end of 2025 is more interesting than 2024, which is around the corner. While the headlines often report on 2024, it's good to see like over the next 12 months or 15 months in this instance what's in the price. And you can see that at the peak we've been priced for 10 cuts. So that was a lot. And we said that, but we don't think that that was unreasonable. What has happened after that is that we're moving from 10 cuts down to 8. That's not because of improved economic data. That's just because 2 cuts have actually happened. So at this point, we're only expecting 8 cuts. But the interesting bit is that slide down from 8 cuts, which are still on the price, were still in the price at the end of September towards the end of 2025, has now been reduced all the way down to actually below 6 cuts, 5.5 cuts. So basically, we lost 2.5 cuts over the last couple of weeks, and that's a reflection of a stronger US economy, potentially eventually more inflationary fears, although that's really not what we see. But the combination thereof leads to risky assets to perform, but the US back end of the curve to perform a little bit slower.
So Hannah, with the market repricing of the last few weeks, how has this impacted our positioning within global funds such as our global income provider?
So that's a really good question, Kelly. The way that we look at it is twofold. So the first way is through interest rates, and we see that the Fed is still, interest rates are still quite high, and the Fed is erring to the side of a slow interest rate cycle. So we still want to position our fund in the very front end of the curve in a 3-month space so that we capture that yield that's still available. And then the second part we look at is credit. And perhaps this is even more important, we see that credit spreads are still quite tight, which means that we're not being compensated enough to actually take on more duration risk. And this actually confirms our positioning in the front end of the yield curve. So the fund positioning as a whole is a lot in the 3-month space, and then with some very high quality credit assets such as your ultra short investment grade credit asset classes. The fund is performing quite well at a 6% yield in US dollars, so that's about 10% in rands. And we believe that it's still very well positioned for anyone who wants to take their money globally.
Thanks, Anna. So, Reza, bringing it back home. South African bonds really had a phenomenal year. I mean, year to date, or to the end of September, it returned 30% in rands. Many may think, it's because of the renewed optimism around GNU. Do you agree with that? What has driven the SA bond performance?
Thanks, Kelly, and hello to all our virtual listeners. It was a pleasure to be able to share some of our thinking and some insights into our investment processes here at Prescient. So the question is, do we agree with the assessment that it's really been some political reconfigurations that has led to the rally and the massive compression that we've seen in bond yields? So the answer to that one is a short no. So we don't agree with that assessment, and let's perhaps unpack the reasons why. So if you think about South Africa's growth challenges and its challenges with fiscal maneuverability, those challenges largely rest on issues that are structural in nature. So just to name some of them, we've got low business confidence, we've got weak capital formation, we've got policy uncertainty, we've got low skills transfer, a very narrow tax base. So these kind of things, the list goes on, but these are all structural in nature. So ostensibly the argument now goes that there was a magic wand that was woven away, and the name of that magic wand is political musical chairs, political reconfigurations, and simply because of that has now enticed the world of risk capital to flow back into South Africa. Now that is obviously nonsensical, and it's quite bizarre and it's quite puzzling how many financial practitioners have actually hung their hat on those arguments. So, but without dwelling too much on what we think is not the proximate reasons for why yields have compressed, let's unpack actually our view for what we think is sitting behind this compression. So we have mentioned for the longest time that we think that the determinants of the South African bond price process, in other words, the determinants, the factors that actually matter for South African bond prices, are almost exclusively global in nature. If you had done some analysis perhaps 30 years ago, you would have found that the factors of relevance for the bond market are completely inward-looking, right? So they would relate to South African growth, South African fiscal position, South African unemployment, and so forth. Post the financial crisis and the portfolio rebalance channel, South Africa became a very popular carry trade destination, and therefore, it makes quite a lot of sense that the factors that now drive the bond market are exclusively global in nature. So the reason for the compression is really a trifecta. It's really three things, right? So the first of these is that we had very attractive starting valuations. In other words, yields were very high. In bond world, high yields or cheap prices. So we had high yields, whether you consider that in nominal or real terms. So very attractive starting valuations. That's number one. The second thing is that there'd been a pivot away from the expectations with regards to how aggregate demand evolves in the US, right? Bastian had just mentioned in the beginning that earlier in the year there was largely almost a consensus view that the US was on a one-way train towards a recession, right? So that got factored into expectations, and the pivot in expectations, i.e. when those expectations needed to be redressed then, to pivot away from the US heading to a recession into an environment where most market participants now realize that consumption has actually held up very well, households have not capitulated, there's no systemic banking crisis, unemployment is rising because the labor force is increasing. That delta in expectations was quite a big move for marketing, right? So the first one, high starting valuations. The second one is the realization that aggregate demand is still pretty okay in the US. And the third one is the prospect of the unwind in financial conditions. That was also a delta in expectations, in some manner of speaking, and it talks towards the points that Hannah and Bastian has made in the beginning, that financial conditions, if we think of the things that are of relevance to the bond market, we're talking about monetary policy in the US, we're talking about the strength of the dollar, we're talking about maybe the slope of the US yield curve. So all of these things, whilst not having changed immediately, the markets have effectively priced in a flight path for how these things will evolve, right? So we know that we are in the beginning of a cutting cycle by the Fed. The speed and magnitude of that may change, but we are embarking on a cutting cycle. Similarly for the dollar, it's now really past its peak of peak strength, and the trajectory, the flight path is downwards. We can mention a number of these things, but there's been a delta in expectations with regards to how tight financial conditions are and how they are set to evolve. So those three things, starting valuations, a change in expectations for aggregate demand, and a change in expectations with regards to how financial conditions will unwind, has really sat behind the rally in South African bond yields. Now, the unfortunate thing is that these three things have happened at the same time as that you had a change in the political landscape. And now, unfortunately, there's this kind of connect the dots type of error that often gets made by some practitioners to equate the inference between the change in what has happened politically and the massive rally that we've seen in the bond yields, right? So that would be our take on the matter.
Thanks for taking us through the determinants. It makes a lot of sense, and it's clear that in terms of our approach, it's very evidence-based, data-driven, and like you like to say, clinical in our approach. But clients or investors may say that's not how markets typically work, and that often say, what about being right too soon, and how that affects your process, and in turn outcomes for our clients. How do you respond to that?
Okay, another great question. So I mean, the reason that we can have this kind of level of clarity and conviction as to what is actually driving the bond market is because I'm taking for granted an initial step that happens in a process. Now, what is that initial step? That initial step is basically in a very statistical and econometric way to first sift through a number of potential variables and to then land on a small number of factors that we think have got predictive relevance for the bond market, right? So the first step is the identification stage. So which factors matter? The second step is then easier because then it says, now that I've identified which factors matter, let me just look which factors have changed, right? And that allows us to have this degree of this conviction and clarity with regards to what's driving the bond market. The problem is, to your question, the problem is that sometimes we can be very clear with regards to the relevance of a change in a particular factor to the bond market. We can be very clear about that. But there can be a long lag before that penny actually drops for the market, right? So we can be right too soon because we've identified a trend that will play out statistically over a period of time, but the market has not quite realized that yet, to put it a bit bluntly, right? So now what that actually creates, it creates a performance dislocation, right? And that is very, very uncomfortable for both clients and ourselves. So the idea is that we looked at our client base and we asked the question, is there not a proposition that we can offer for clients that are a lot more benchmark centric, right? They want somehow to gain alpha, they want exposure to the bond market, but they want to have their tracking error or the deviation of away from the benchmark to be much more risk controlled. So the idea is that they want a smaller tracking error, but they don't necessarily want to compromise their information ratio. What is that? Very, very basically, it's the unit of outperformance per unit of relative risk, right? So they want to maintain a small tracking error, but not compromise their information ratio. And that is the perfect inroad for, drum roll, the Prescient bond portable alpha proposition. So what it basically speaks to is exactly that point for investors that would like systematic exposure to the South African bond market as a whole, to have outperformance of that, but basically to do that in a risk-controlled way, in a tracking error-controlled way, without necessarily sacrificing the information ratio. So that was the idea, and portable alpha is not by any means new to Prescient. It's not new to the South African investment management landscape, and very basically what it tries to do, I'll show this to the viewers in just a short while, but the building blocks basically is to give investors synthetic exposure to the bond market. That sounds like a rude word, but what it really means is that it gives you economic exposure to an underlying market without tying up your capital, right? So you get exposure to the bond market, it doesn't tie up your capital, you are then free to deploy that capital somewhere else. However, it's not completely free. There is an underlying almost funding cost associated with getting that synthetic exposure. So the idea is that you would outperform that funding cost, or what's running in the background is your synthetic exposure to the bond market, and the two together would give you exposure to the ORBI plus any alpha that you would add over and above your funding cost. So it sounds like a mouthful, but it was really just very, very simple building blocks. It's not a revolutionary proposition. Portable alpha strategies have been around for a long time, but I'd like to take you through some steps from our portal to explain just how the mechanics works for Prescient specifically. So the portfolio that you see in front of you is the end result of our portable alpha optimization process that effectively tries as its goal to outperform a given funding cost. In this case, the assumption is that that funding cost is JIBAR plus 60 basis points or JIBAR plus 0.6%. And this portfolio has been optimized with regards to a number of risk criteria. So what we can do, and what we think the approach is a little bit novel to Prescient and something that we're doing a little bit different to our peers that may be offering similar propositions, is in the sophistication of the optimization process itself with regards to being able to optimize over a number of risk metrics. Some of these risk metrics might relate to tracking error, expected shortfall, outright return, and a number of other ones that we are able to do simultaneously. What we do see is that the eventual solved alpha portfolio has got approximately 80% to floating rate notes. This is no surprise because one of the risk metrics, as we mentioned, relates to tracking error, and if your benchmark is struck with regards to JIBAR, i.e. if the benchmark is JIBAR plus 60 basis points, it's no surprise that the matching asset for the alpha portfolio has a large allocation to floating rate notes as well. Thereafter, we see other instruments that the optimizer prefers to have on the term structure, from NCDs that are negotiable certificates of deposit from our large four banks. We see some fixed rate duration instruments in the form of the R2030, the R186, and so forth. But these constitute a very, very small amount, because the idea here is that this matching alpha portfolio is simply trying to outperform the JIBAR-related funding costs with the highest probability of outperformance and the lowest tracking error. So it wouldn't make sense to have too much fixed rate duration instruments in here, and from what we can see, they don't actually constitute a major part of the portfolio. The bulk of the portfolio is constituted by the 80% in floating rate notes and the proportion allocated to NCDs. Now, what actually happens is that every day we actually take in initial yields from each of these instruments on the term structure that gets fed as inputs into an optimizer, and the process is run and optimized every day, and it will take into account automatically the changing shape of the term structure should interest rate cuts or any other phenomena manifest themselves in the term structure. We think that this approach, as I said a little bit earlier on, portable alpha is not a revolutionary strategy in the South African asset management landscape, but we do think that the second leg of the process, which relates to how clinically and how statistically we can create the matching alpha portfolio to outperform the benchmark with the lowest tracking error, we do think that the sophistication of this process is something of a differentiator, and we are proud to actually put this into action into our bond portable alpha strategies that was launched at the beginning of September.
Thanks, Reza. So it really seems like it is quite a compelling proposition for clients, and I can confirm, clients have been very interested in this, and since launch, there's just been so much engagement on it. For those clients that, also prefer to have a more unconstrained approach, they also have our Prescient Flexible Bond Fund, and perhaps for across the board in terms of client interest for our bond offerings, could you provide a bit of an outlook on SA term structure for 2025, what we think our dominant themes will be, and then, what should investors look out for?
Sure, thanks. So maybe the first part of the question, just to sort of juxtapose the flexible bond proposition with now the portable alpha, which is now the latest proposition. So what the flexible bonds aims to do, it aims to outperform the term structure, the entire term structure over rolling 3-year periods in a duration unconstrained and sector unconstrained manner. So the prospect of alpha within flexible bonds is a lot more material than what it would be in a little bit more pedestrian portable alpha. But almost like the little bit of the caveat there is that performance and that outperformance is not delivered in a straight line. So there can be times that you can espouse quite significant relative risk to the orbi and in fact sometimes quite significant absolute risk as well. So it just depends on the quantum of outperformance that you are after as an investor, and it also depends on your appetite for taking on differing amounts of relative risk. That's how I would juxtapose the flexible bond proposition with portable alpha. But in terms of an outlook and just picking up some strands, I think the dominant theme, rounding off the end of 2024 and looking through the vista of 2025. I mean, Hannah mentioned some ideas early on about how the global income provider proposition is positioned with regards to still a lot of value in the front end of the US term structure, and that occupying the bulk of the portfolio composition in that particular proposition. Now, in some sense, the attractiveness of the US front end and the tightness of financial conditions is basically saying the same thing, right? Because if you have, so the front end of the US curve is a captive to monetary policy, right? Is a captive to the decisions of the Fed. Now, that is making its way from well over 5%, embarking on a cutting cycle, which we will see evolving over the course of the end of this year and towards next year. But as that cutting cycle basically gains traction, the attractiveness of the US front end also comes down in lockstep. And so what I'm saying is the unfolding and the less tightening of financial conditions also goes hand in hand with that front end becoming less and less attractive. Of course, my colleagues will find other compelling opportunities, but what I'm simply saying is that those two things are effectively saying the same thing. So what we will see happening towards the end of this year and into next year is this unfurling and this lessening of the very, very kind of tight financial conditions that we've seen. And when you couple that with, as taking a strand from Basti's page, when you couple that now with a US economy that has not capitulated, i.e. you couple this idea of financial conditions becoming much, much less tight, the US economy, the US front end not becoming so compelling, sucking up capital, and a US economy that has not capitulated, once you combine those two things, it's actually very, very positive, and it sets an incredibly positive backdrop for carry trade destinations and for risk assets in general. So the one thing that we would also point out is that if you look at what is set to happen with regards to maybe monetary policy evolution here in South Africa, what will generally happen is that we will also embark on a cutting cycle of sorts. What typically happens then is that the front end of the curve the yield curve tends to steepen, and the front end of the curve in absolute terms tends to lower down, right? Now what that happens is that's not so much consequential with regards to front end strategies, with regards to front-end benchmarks, because they will both move in lockstep down. So you don't have a problem outperforming a front-end benchmark. But what you generally find is that as that front-end moves lower in absolute terms, the quantum of real return that a front-end instrument is able to give over inflation becomes less compelling than what we've seen in the Goldilocks period in the past 2 years. The front-end was able to give 10 or 11%, and inflation sitting at about 4 or 5%, right? So that's a very compelling real return. So what we are saying now is as that front end comes down, you won't get 10 or 11%. And if inflation stays more or less range bound, the real component of a front end instrument tends to become lower. Now, this is not in any way to detract from any of my colleagues, but I'm simply saying that environment typically sees investors looking outwards towards the yield curve and looking to harvest term premium. And that is usually a context that bonds become in vogue again. So one of the things that it will likely be a theme, with the US being okay, with financial conditions becoming less tight, with our front end moving lower, is that investors will look outwards, try to harvest term premium, and try to look for ways to get their hands on real yield again. And that is a very, very good recipe for the South African bond context. And maybe I can just show you some sample expected returns that we are able to generate from our portfolio to give an investor's idea of what kind of things are on offer. So what you see in front of you is really the summary dial of our systematic investment scoring process that takes into account what we like to call 4 meta factors, and they relate to valuations, economics, financial conditions, and sentiment. Each of these have some underlying building block drivers, which it's not necessary to go through that now. But effectively what we can see is that the South African bond market at the moment is characterized by still having very attractive, strongly positive valuations criteria, and this speaks to the point that I made a little bit earlier on. Even after the rally that we have seen, even after the compression that we've seen in the past 3 months, the valuation scores, i.e. how high yields are still screaming at strongly positive. And then we've got a little bit of a tug of war between the valuations component, which are pulling towards having more duration, and then economics, financial conditions, and sentiment, all in the red. And those relate to basically, as I said, as yet unchanged, but the trajectory of change within financial conditions and economics, and for that matter sentiment as well, is on a flight path of change. Many investors have in fact looked through this, and this explains a lot of the interest with regards to, as I mentioned, the South African bond market. So what we now do is we are able to generate a score that takes into account all of these factors, and we are able to create a set of expected returns for all the bonds on our term structure, and I'll show that to you quickly. So what we can see here, hopefully that wasn't too fast, but effectively what we've got here on the x-axis are all the initial instruments that we find on the term structure, from treasury bills all the way from the shortest bond now, which actually used to be the benchmark bond, the R186, the 2030, the 2032s, all the way up to our ultra long bonds, the 2044s, 48s, and 53s. And what we've got here right at the end is an expected return, a value for the all bond index, conditional on being in a particular score. As you would have seen a little bit earlier on, just a moment ago, the score now is in neutral. And that's exactly why the current returns that you see, the expected returns, takes that score as given. Should that score move, let's just say we do indeed see an improving economic landscape for aggregate demand and a less tight environment for financial conditions, the score might ostensibly move to moderately positive, and we are able then to generate scores for all the bonds on the term structure, conditional on being in that state. How do we do this? Because simply speaking, once we are in a given state, we can look towards the past. Once we are in a given score, we can look to the past as how the yield curve has typically reacted to being a similar score in the past. And that gives us some conditional information as to what to expect from this point going forward, should we be in a given state again. So moderately positive, should the dial move there, we can see that we are getting a lot of value, a lot of return from the belly end of the curve. Should the dial move a little bit more to the right, into strongly positive, what we can see is that the back end of the curve tends to sort of take pride of place there, with the 44s, 48s, and 53s registering almost 15 or 16%. So we're not in those states yet. Our scores haven't sort of amalgamated to get us into a moderately positive or strongly positive state. We are still in neutral, but we are just looking down the barrel around very, very probably where we might end up in the early parts of next year. Conversely, should the curve actually move towards the other direction, i.e. should we get a more adverse aggregate demand background, should financial conditions actually stay tighter for a little bit longer, what we can see that now is that the front end of the curve towards the belly, that starts to scream at a little bit more value, and that's actually where we can see the bonds registering, the 2035, the 2032, and the 2030 then starts to look a lot more attractive in that state of the model.
Thanks, Reza. Hannah, the portable alpha strategy that Reza referred to gets created on the short end of the yield curve. Given how the fixed income environment has changed, what is the market pricing in terms of interest rate changes in South Africa going forward? And how have we changed the present income provider positioning over the quarter to take these into account?
Cool, thanks Kelly. Let's first look at the consensus on where interest rates are going through market pricing. We're going to look at it through looking at the yield curve through the lens of the forward rate agreements. If we take a look at the forward rate agreements curve 1 month ago, we can see that the market was pricing in cuts quite aggressively. However, the current forward rate agreement curve prices in cuts a lot less. So this means that we expect interest rates to still come down. However, they are going to come down a lot slower. The shape of the curve is very similar to that of the US, but the depth of the curve is a lot less. This could be attributed to the new inflation target, upon which there have been lots of talks of the inflation target lowering. But none of this is concrete yet, and this is something that we stand to monitor. This does formulate a lot of the reason as to why a lot of the fund is positioned in the front end of the curve so far. Okay, let's look at the 3-year swap curve versus the 3-month JIBAR rate to help us decide whether we should start to enter positions with more duration, given that rates are on their way down. So looking at this chart, we can see that the spread is narrowing, meaning that markets are becoming more favorable to take on more duration. However, the spread is negative and the yield curve is still inverted. And so we're still not getting compensated enough to take on 3-year risk versus taking on our 3-month risk. So given that the interest rates are coming down and that credit spreads are loosening slowly but are still quite tight, we've positioned the fund quite diversely across the entire yield curve. We are still a little bit front-end heavy, but we've positioned ourselves in the R32s, 2032s, such as the bond teams, just to get some of that duration and pick up from that yield in the belly of the curve.
Okay, so as we continue to navigate these uncertain times, how do we manage the risk within Prescient Income Provider? Because we have a capital preservation target that we need to maintain.
Yeah, that's an excellent question. So the Prescient Income Provider fund itself differentiates from the interest-bearing market in South Africa through its philosophy of never losing money over a 3-month period. And to execute this can be quite tricky. So we dissect our risk in 2 main pillars. The first pillar is, well, if we were operating optimally, how much risk can the fund hold completely, fully? And we measure that based on our expected returns and our forward-looking views on each asset class. And then the second way that we look at it is, well, where are we sitting right now? Currently, with what we hold, how much risk are we holding? And the difference between those 2 risk measures gives us a risk budget. Are we in an environment where we can be risk on, or do we have to just take risk off so that we maintain that capital preservation?
So it's been quite like we say, uncertain times, bit of a tough environment, but we've still seen Prescient Income Provider perform pretty well. What have been the drivers over the quarter?
That's correct, Kelly. So the 3rd quarter has actually been our strongest quarter, as Reza dissected how the year has been and how rates have been going throughout the year. We've started off a little bit negatively, and then we came into a very strong 3rd quarter. However, our duration side of things, so we stepped into a bit of a duration. We got a lot of pickup from our bonds section of the portfolio, and then also we found a lot of credit instruments that have actually also helped just add on that extra bit of yield. So just to put it into context, the Prescient Income Provider has yielded 13.5% gross fees over the past 12 months, with very little duration of about 1.5 years, which I think really demonstrates how when we systematically implement our risk strategies and our performance strategies, we can really delve out a lot of yield through the markets, no matter what the conditions are.
Thanks, Anna. We really are proud of how our Prescient Income Provider has performed and what we have done for our clients through the fund. You touched on credit, and this is where I'm going to bring Michelle in. We've had the macroeconomic backdrop. We're speaking about the interest rate cuts. It really has had a positive impact on our capital markets. From your point of view, what are your comments around this?
Thanks, Kelly, and thanks to the listeners for the opportunity to talk to you today. I think let's just take a step back and think about where we were at the beginning of the year. There were several unknowns. So we had national elections coming up. We were uncertain around load shedding, for example. And then there was the story about rates being higher for longer. And so a lot of unknowns we didn't actually know, like in terms of what this meant for the debt capital market. And all of this obviously impacts sentiment. It impacts the cycle or credit cycle that we're in. And so looking at that and taking into account now, fast forward a couple of months, we've gone through the national elections, GNU, Reza already touched on expectations from the market. Load shedding reported 200 days roughly of free from load shedding. Again, positive. That means businesses can operate, they're not spending as much on diesel, etc. And I'll touch on why that's important. And then thirdly, of course, the interest rate cycle, higher for longer cycle has come to an end. So there's some reprieve in terms of that 25 basis points that's come in. So what does this mean from a numbers perspective? Are we actually seeing that in the numbers from a capital markets perspective? So if we're looking at gross term issuance, it's sitting at a year to date 116 billion. If we compare that to the same period, 112 billion, it's not a significant increase. And if we compare, just September was quite a busy month in terms of auctions, issues coming, about 20 billion of that. And so this tells us that there's not significant issuance in the market. That can be multiple reasons. It can be a growth story, so we're not seeing the numbers come through yet. So that will take some time, it will be a lagged effect to see issuance come to market. So we're not seeing the issuance come. What we are seeing is that issuers are coming a lot more to the market, so moving away from private placements to auctions, allowing for price discovery, allowing investors to actually participate. So that's positive. So in effect, in the dynamics in terms of market dynamics in terms of demand versus supply, there's still a mismatch. And so it can be skewed, or basically the view can be skewed from the perception of that there is a lot of activity because of that demand outstripping supply. But that's actually not the case when we see there isn't new issuers coming to market. We only in the last quarter saw one issuer come to market, a new issue. We're still seeing delistings. So it's not in the numbers. And if we're looking at the last quarter upcoming, there's about 16 billion upcoming redemptions. So very much a theme of redemptions coming up and refinancing. So we're not seeing that M&A activity, the mergers, the acquisitions, which speak to growth. We're not seeing that come through in the numbers as yet. And hopefully when the growth story starts unfolding, we start seeing a lot more positive turnaround thereof, policy reform, etc. Those things implemented alongside business being able to operate now that load shedding we're free of load shedding. That means businesses can then use that capital and use it for capex, use it for further expansion, which ultimately brings about the need for more issuance. So while we're not seeing it come through in issuance numbers as yet, it is positive from a borrower's perspective, because think about rates now coming in, that means serviceability improves. That then filters down into probability of default, which can improve as well, which ultimately means it's positive for investors in the end.
Thanks, Michelle. So what we're seeing is that demand continues to outweigh supply, and that's clearly a driver for the spreads continuing to tighten, despite the low growth story that we've spoken about. Given that the market conditions continue to have the spread compression and the continuous search for yield, how does your team balance that asset allocation versus fair value?
Thanks, Kelly. It's a very good question. And I like to brag about the Prescient process, is that it's so robust and it's systematically driven. So it's data driven, it's been tested and tried, and it ultimately informs our investment decisions. And we've spoken to length about our credit cycle indicator, which helps inform where it is that we should be positioned from a cycle, but also where the market is going and how spreads are reacting to that. Before I showcase that, what's really important is the backbone of what we do is our process. So we have a robust process that we're able to use millions of data and assess that to inform our decisions. Number two is leverage the team that we have. We have a competent, skillful, experienced team that's been through in the market through various credit cycles. So that obviously helps when we are assessing opportunities, mitigating risks, etc. And then, of course, using all of those levers in order to facilitate diversification. So using the tools and help go out there in order to get that balance the asset allocation with the fair value or return target for the respective funds. So by way of illustration, I'll just take you through where we are in the credit cycle indicator and what that actually looks like from a spread perspective. So what we're looking at here is our credit cycle indicator, which ultimately has various inputs or macro inputs that plays a part in assessing where the credit is in any given cycle. And of those is sentiment, both from business and consumer, but also the overall even exchange rate or CPI as well. So what's quite key here is that we can see that the credit cycle indicator, looking from 2020 to 2024, we can see that it's actually on a downward trend. That indicates that risk has actually come in, which ultimately informs lower probability of default, or rather improved probability of default. So what that actually looks like from a weighted average spread perspective, we can see that that also has come down at a lot faster pace than our credit cycle indicator. So how we balance our asset selection, we actually have to drill down into the sectors, and within sectors also look at where we can find the pockets of opportunity for instruments, or rather issuers that are defensive throughout the credit cycle, and that has really good metrics that ultimately informs our fair value. So what we're looking at here is each of the sectors alongside our credit cycle indicator. And if we were to just look on a per sector basis, we can see from a banking perspective, there we can see that the probability of default, which is the indicator here on the right, that has come down. Corporates, the same theme over there, as well as more REITs and SOEs, tapering down, but on the SOE still elevated, but moving more on the sideways. So I think what's really key is that we continue to look for pockets of opportunity for issuers that are defensive in nature, but still remaining conservative and still remaining true to our investment philosophy of having that capital preservation, that we meet our benchmarks and we fair value these instruments. So Kelly, coming back to what I was saying from a diversification perspective, so we able to assess issuers, over 300 issuers in the market, and really drill down to the analysis, doing the due diligence pre, during, and even post is very important. And how we're able to balance it is we're able to use various tools. So meaning we can go across the type of instruments, that being floating rate notes, fixed rate notes, and even structured products. I think what's really key is that whatever we invest in, we understand. So before we actually invest, we understand, we go into what the potential risks are, and we really look at how we can mitigate that and make sure that we are fairly compensated for that. So how we do that, we look at the C's of credit, for example. So I'm just going to touch on maybe 3, is to ensure looking at character, not necessarily the people element, but looking at the track record of how that company has serviced their obligations or data obligations over time. Is there a good track record of actually seeing that in the numbers? From a capacity point of view, but also from a capital point of view, how much buffer is actually sitting in there from a liquidity perspective? Can they actually take on this debt? And really doing the sensitivities in terms of the analysis and metrics of those specific companies. And ultimately, what we do is we do a deep dive. We ensure that we understand from a systematic point of view. We look at the numbers. That drives our investment philosophy of capital preservation and ensuring that we don't lose money, like Hannah said, in the short term for some of the funds. And ultimately, we work together. It's not a siloed team. So, we talk to the bonds team, we talk to the cash and income team, and ultimately have one view to understand where we are in various cycles so that we can remain agile. And this ultimately is all informed by having that robust process and making sure that we're still able to meet, if we're looking at JIBOR, which is at 8, we're looking at where the forward rate's going, there's still a room for credit. There's still a really good case for credit. And so credit ultimately gives you that stable returns. It's very different from a volatile equity market. So we can still pick up really good yields that are we able to outperform our funds. And I mean, it's showcased through the income provider, through our other credit funds. The case is there.
Thanks, Michelle. So everything you've just clearly demonstrated just shows that there's still value in credit. And everything that you guys consider to ensure that we get the best investment outcomes for our clients that are invested in credit products. And for those that are looking for credit exposure, we do manage Prescient Income Plus Fund. And on top of that, we also have our infrastructure, clean energy and infrastructure debt funds. So could you perhaps give us a little bit more information on those?
Thanks, Kelly. So The Income Plus Fund is ultimately our high yield fund. It's a sister fund to the Income Provider Fund. So ultimately it is a channel for other funds to actually get exposure to credit. The fund has performed or outperformed its benchmark since 2020. And ultimately currently yielding at almost 12%. So that's quite good, and it's just marked just over 5 billion. So since being here at Prescient, we've grown the fund to a state of robustness and at a healthy state. And that's testament to the fact, again, bringing it back to our process that works. And number two is the diversification across asset classes, across issuers, managing that risk, making sure that we we mitigate the risks that sit. We manage over 100 issuers or instruments in that fund. And we're able to do that by leveraging the levers that we have, doing proper analysis, looking at the numbers, letting that be the driving factor. And ultimately, we're still able to achieve, I mean, that almost 12% yield is testament to the fact that we are able to diversify across listed, govies, liquid basket, but also unlisted. Because this fund is Reg 28 and BA 90, it provides us that channel to also go into that unlisted channel, so which gives us an additional pickup, for example, and allows other funds then also to get channels of exposure to credit. I think that's really important, is that with the rate cycle that we're in, it's coming down. There's a case, the pipeline is growing. We're able then to deploy our clients' money and in a responsible manner. And with our other two credit suites being the Clean Energy and the Infrastructure Debt Fund, again, they're outperforming and pipeline continues to grow. And alongside the story of wanting to turn around the infrastructure within the country, providing renewable energy or reliable energy, there's a case to invest in these type of investments in a responsible manner. And we've been able to showcase, but the way in which we do things is it actually showcases in the numbers. We're able to demonstrate that to our clients. We have over 6 billion in pipeline. So opportunity is there, and we continue to go on the road. We continue to sell the story. We continue to showcase how we are able to, number one, invest in credit, which is considered more risky than a money market, for example, still able to provide stable returns and beat our benchmark.
I think overall we've covered quite a bit of content here today across the interest-bearing space. Basti, just to bring it all together, and perhaps, considering what clients, the question that comes to mind is, what's next? Yes, we've heard what's happened in the last quarter, how that has impacted our funds. But can you perhaps give us an outlook for the remaining weeks of the year and then perhaps leading into 2025?
Yes, sure, Kelly. I guess mostly everything was covered today. I guess a core theme for the remainder of the year definitely is going to be the cutting cycle of the Federal Reserve. So we have embarked on a cutting cycle, started with a 50 bp cut, now repriced a little bit to a slightly slower pace, but it's going to be cuts. The question is going to be how fast and how many. That's the first positive. The second positive would then be that re-acceleration of US growth, which could be very beneficial for emerging market bonds, and that puts us into a stronger space for risky assets like our SA government bonds with a little bit of duration. So those are the tailwinds. There are headwinds as well. So the first one to cite would probably be, there's quite a few of them actually. So definitely the wars in the Ukraine, or basically the war in the Middle East, which is at risk to escalate further. That could have potentially, even if transitory, but it could have an impact on inflation. The first one. The second one is obviously that we have this massive stimulus in China, which is coming through, but is it really big enough? And what are the economic consequences? Is it going to fizzle out, or is it going to be maybe more? So that's the second uncertainty. And the last one, obviously, US election. I mean, something very important with elections, which are so much on the edge in the biggest economy of the world. So you can't ignore that. We do think we've got it all covered in our investment process, so we're not worried, but definitely a more cautious stance for the remainder of the year remains something which we think is the way to go.
You mentioned the Fed moving a little bit slower and SARB most likely will follow. Could you drill down a little bit into the fixed income outlook?
Yes, 100%. So our fixed income outlook is obviously always purely systematically derived by those factors. I mean, Reza mentioned quite a few of them. It's always informed by economics, financial conditions, sentiment, and then the pricing points, so the valuations. And if we bring that all together right now, we would say that in the credit space, we know that spreads are tight globally. You don't really get paid for pricing risk, for taking risk. In the local space, similar story. So we've got tight spreads, but we do have an attractive credit suite, which Michelle explained quite nicely, I guess, where we can see that it's still possible to eke out returns, especially since these instruments are mostly linked to the front end of the curve, which remains elevated. So, long story short, credit risk taking, a lot of credit risk taking is not really worth it. Does it pay to take duration risk? Well, in the global space, not so much, because we've got a term premium which is pretty much at zero or slightly negative, like hovering around the zero line. So that's definitely not something where you get paid for. And in the local space, I guess that's where it's difficult. So we don't like duration in the 2 or 3 or 4 year space, where we've got that inverted yield curve as well, at least totally flat yield curve. So it doesn't pay to take any risk there either. But then once we venture out into like what Reza called the belly of the curve, that's where we position our bond funds, and that's where you actually do pick up quite a bit of term premium. So locally, like we like that barbell, like very floating in the very front end, but then also some exposure to the belly of the curve. And globally, we like really, as Anna explained nicely, we go very conservative right to the front end of the curve.
Thanks, Basti. Thank you to all of you for joining us today, and for the viewers out there. It's very clear that here at Prescient, we consider it all to ensure that we get to have our best investment outcomes for our clients. Please feel free to continue posting some questions, and we will address them straight after in a live Q&A session. Morning and welcome to the live Q&A. Thank you so much for joining once again. I know it's been quite a long session this time round, so we'll try and keep it as brief as possible. So jumping straight into the questions. First one is, what do you think, and I know we touched on this in the webinar, but perhaps you can give us a little bit more, is what do you think the repo rate will be at the end of the current interest rate cycle?
It's a good question. So in terms of the repo rate, this is not something which we model explicitly, because we think that what is relevant for security prices is actually what is factored into expectations, and security prices react only when there's a change in expectations. So the expectations with regards to how the repo rate will evolve is mostly read off from the broker. And what we can see in terms of the current cutting cycle, there are about 3 cuts that are still priced in for the current cutting cycle before the nominal repo will sort of bottom out and start increasing again. So that will happen over the course of the next year. I stress this is current expectations, and it's informed by a plethora of things. It could be the strength of the rand, it could be a range of global phenomena. But current expectations is that we bottom out more or less in a year's time, after having basically cut in increments of 3 times in increments of 25 basis points.
Another bond question. There have been 2 new bonds issued in South Africa, the R2033 and the R2038. Are these part of your investable universe? How would you go about incorporating it in your process for funds?
Another good question. So what we essentially do is that we model all the bonds that are on the term structure in terms of the relevant expected returns. Now, we know that the expected returns on any bond is a function of several things. It could be, well, it includes the coupon rate, it includes its roll down, it includes its pull to par effects, and various other things that we incorporate into the expected returns of any bond. The 2 new bonds, they will basically enter into the grinder like any other bond, and we will expected returns lens, and basically they will get factored into the process through the normal optimization that we've taken through in the webinar itself. So the one thing that we would point out though is that when bonds are typically new, when they've only recently become issued, there may be some problems with liquidity, because it's not immediately the case that they will become part of the index, right? So we generally wait until they become part of the ORBI, and that you have relatively strong and liquid 2-way pricing for those bonds, less we should want to get out of them. So initially, they are part of the opportunity set, but we basically just are a little bit circumspect around how quickly we want to participate in them, mostly on account of the liquidity that's available.
Reza. One on ESG here, Michelle, this is probably for you. There's been a lot of controversy regarding the relevance of ESG. In terms of your process, how is ESG viewed and incorporated in this, and how is impact measured?
Thanks, Kelly. I think that's a very important question, and also relevant in the sense that there's been a lot of news flow with regards to ESG and the relevance thereof. So while there is obviously a lot of critique around ESG, I think what's really important is that it's easier to say it's a matter of the way in which it's viewed and the way in which it's used. So the way in which we look at it is very much systematic, very data-driven. So we developed our own proprietary in-house, based on first principles, methodology. It's based on 62 metrics across the SNG. And ultimately what we do is we take information that these companies ultimately disclose in the integrated reports. And we have across these 62 factors that we deem is important to evaluate ESG from a risk perspective. And that gets ultimately fed into our overall risk assessment alongside some of the other credit metrics to get a full sense of what the probability of default for any opportunity issue is at any point in time. So why that's important, because ESG, what we found is that there is relevance for ESG. We've seen these studies that has proven that ESG or issuers with positive ESG scores actually perform and is more sustainable in the long run. And so there is a case for why ESG is important and should be incorporated. We've also seen a lot of corporate failures, specifically in our market as well, that came down to governance, for example, and it had financial implications. So obviously, as a debt investor, we have to consider it all. And that includes these non-financial factors. The way in which we do it, however, is more data-driven, unbiased, and that's ultimately why it's important. Secondly, the way in which we look at impact is ultimately using that data and comparing year on year how a company has either saved on water, how they have reduced their emissions, and we can actually track that over time. Over and above that, aside from listed companies, we also do it for unlisted companies where we actually go beyond that. We have about 80 plus metrics where we're able to assess what is the impact, how many jobs have been created, what sort of community involvement, for example. These are all important questions that our clients also want to know. And I think, I know we're very stretched for time, but in terms of our full process and in full impact analysis, we do have a sustainability or responsible investing report that we do put up on our website. It's available for everyone to read and use. And if there is questions, reach out. We're happy to engage further.
Thanks, Michelle. And that concludes the questions for today. As Michelle mentioned, please feel free to visit our website if you want any more information on any of our funds, or reach out to your business development manager for any more information. Thank you very much for joining once again, and please enjoy the rest of your day.